Yeah, so namaste to all. Myself, Dr. Mallikarjun Rao, Assistant Professor of Commerce, Government City College, and also uh, I'm also counselor for Dr. B.R. Ambedkar University last 15 years. So my area specialization is finance. I did my MCOM, MBA, PhD, and I have 15 years of teaching experience in including UG and PG. And so today I'm going to teach you. The paper is financial management, and it is one of the major major paper in your course. So PG diploma in financial management, major part is financial management. So am I audible? It's my voice is clear, everyone?
Clear, sir. Clear, sir.
Yes. Okay. So now we go to first briefly discuss about our content. What are the topics are there in our syllabus? So let's start with discuss only in the contents of a syllabus. So in our part, in our course, this paper, we have a 5 blocks. Each block, 3 or sometimes 4 units are there. Okay. Each unit. So each block. Okay. Each block. The first block name is financial management. Here we'll discuss the overview of financial management, and under unit first one talks about financial management and its introduction part. The second one is financial planning and forecasting. So every firm has some plan, financial plan is required, and how are these forecasting in the future based on the long term, 5 years, 10 years, 15 years. Third unit talks about this time value of money is a very important a topic in any kind of financial decision making, either individual or firm or any company, the government, anyone has applicable the time value of money. So first block is purely the introduction part. Coming to second block is investment decisions. So investment decisions, and we discuss on we will discuss on capital budgeting. What are the techniques of evaluating the capital budget techniques? The risk analysis in capital budgeting analysis. Right? So every firm has some investment decisions required. The firm has to grow. The firm has to enter in multiple business segments. They have to improve the business model. So they require huge amount of investment. Because the word itself indicate capital means a long term, right? It's a 1 year, 3 years, 5 years, 7 years, 10 years, sometimes 15 years, right? So that topic we talked on investment decision in block number two. Block number three is financing decision. Under financing decision, we talked about what is various sources of finance, right? So what are internal sources, external sources? Every firm, the sources are required. If company has a good investment options, but company has facing a problem for source of finance, maybe it may be a problem. Then our topic is eighth unit is talk about capital structure. So capital structure under what is the company structure? Capital structure is there. How much equity is there in their balance sheet? How much debt is there? Is the company is risky company or not? How there? What is the stake of these promoters? Right. So like we will see this total topic we'll see in the company balance. I think everyone knows company balance sheet, right? Company balance sheet. I think everyone knows the company balance sheet, how it looks, right? Company
Yes, sir.
balance sheet. Yeah. So this topic we talked about in company balance sheet, liability side. So this we will see in the company asset side and liability side. Third one also will see the dividend decisions. If the firm has good returns, good profits are there, right? So these profit, how the firm can managing these profits. The company has two options: either distribute the profits or retain the profits. So the profit won't not pay any interest to the any banker or nothing is there, right? Profit is a very good source of finance of every firm, right? Every firm has to increase, every firm has to grow itself, every firm has to grow itself, the firm, all these, right? So this topic also we'll see in the liability side, how the company will take a decision regarding the dividend decisions. Dividend decisions. So after that, our Fourth topic, fifth block is working capital management. So it is also very most important in any firm, either small scale, mid firm, large scale, so any firm, the working capital management is very most important. So it talks about liquidity versus profitability. How much the cash can manage the firm? If the cash is shortage, how the firm can run? See that the company has sell these sales to everyone, giving the loans, credit sales are increases. But what about these cash flows? How the company can meet their liquidity positions? So that talks about in the block number 5, estimation of working capital, inventory management, accounts receivables, cash management. Like we talked about everything on the company balance sheet. So this is our overview of 5 blocks, and every weekend we will cover one block. Okay, so this today we covered this introduction part, block number 1. So that is financial management and overview. Okay, so let's begin with our first block, introduction part, financial management and an introduction. So what is financial management? So here they see the importance of financial management, functions of financial management, meaning of business finance, right? Definition of financial management, all are given all this topic. So why is the financial management very most important? Right? The firm, every company has to grow. Every firm wants to give a larger company. They want to increase the company sales. They want to increase the market share. They want to be market leader. So how the firm can grow? How the firm can be grow as the market leader? So if the firm take an appropriate financial decisions, financial functions are required. Right. So that is the reason the financial management is very most important in any firm, either small scale, large scale, business scale. See, if they want to start a business, the finance is required. So if to pay the premises, everything without no, finance is a lifeblood. So like without blood, we can't survive. The firm is also same. Without finance, the firm cannot be survived. So that is the reason the finance is a very most fundamental concept. Any firm, right? Without firm, the firm cannot generate, they can't grow. Right? What are the functions, right? The functions of financial management. What these financial management do? So financial management give this company path, how the firm will grow in future. What are the investment options are there? How the company can procure the funds? How they utilizing the funds? How they satisfy these various stakeholders, right? Investors, board of directors, employees, customers, tax regulate authorities, like everyone watching the company balance sheets. So how the balance sheet now, you see that if a business model is good, the company balance sheet is also good. If the business model is not good, even though if a good balance sheet, the firm can also lose their profits. Right? So traditionally, the financial management will do is only the procurement of fund size. We are focused in until before 1950s, the financial management nothing but only procurements of funds. So where to procure the funds, and the only procurement that too it's only for long-term purpose. Ignore, they won't consider this working capital management. Earlier days, before 1950s, so when in initial stage, the financial management talks about only how the funds can procure for long-term purpose, not for short-term purpose. But now, today's emerging days, every day is a very most important. 1 week, 1 week, 1 month, 3 months, a lot of changes happening in this business models, right? So now, we also see that they ignore the total working capital management in internal uh, starting days, initial days. Then also they ignore the allocation of funds. So they're focusing on the one hand, how to procure the fund for longer purpose, but they ignore the other hand, whatever they procure the funds, how to allocate. Right. For example, one company is there, they want to know recently 2, 3 companies are come forward to issue the IPOs. So they said that if they buy the company shares, so say that these amount we can utilize for clearing our debts, or we need to enter new business models or expanding our business, right? So like the allocation of funds, how the firm can allocating its resources. So that is there in previous 1950s. But in modern approach, But there are a lot of changes happening in this, whatever the market size increase, global US economy, and new theories, emerging theories are there, new people, right? New theories, then new kind of business models are there. When in modern approach, financial function, wider sense, it includes both procurements of fund as well as utilization of funds. Whatever the limitations are then earlier, now it will be effective of using these sources. One hand, we procure the funds. Another hand, effective utilization of funds. Right? There are two hands. First, we have to procure the fund. Then we have to utilize effectively and get good revenues. Increase the company's sales. Right? Increase the company's sales. The two ways. One is top line growth, what we call bottom line growth. Top line growth, nothing but increase the company's sales. The bottom line, nothing but the EPS earnings of the company. Right? So we'll see these in the modern management, modern approaches to financial functions. They're focusing on these two, and the finance has to be an integral part of all our management. Earlier days, the only financial planning and raising the funds, but now in modern days, it includes all steps. All these management functions are related to finance, allocation of funds, financial control, right? Consider all business decision, investment decision, management decision, financial decision, dividend decision, and all are applied for the modern approaches. Then acquisition of funds, right? As earlier I told you, without funds, the firm cannot grow. So how acquire the funds? Where the firm can get the funds? Right? If there is the issue of equity shares or issue of preference shares or debentures, long-term loans, maybe various sources, right? So how the firm can approach? So see that each source has its own limitations. Share capital, it may be depending upon the various regions, and preference shares is also, the company has to pay fixed percent of dividend. Debentures, the company has obligation to pay irrespective of company profits, interest has to be paid in their debentures. Long-term loans, see that long-term loan the company has to pay interest irrespective of company profits. The company has to pay the interest. After a certain period, the company has to pay principal amount also. But whereas the equity shareholders no need to repay the company. If the company go for buyback, then only the company pay. Otherwise, the company no need to pay any amount back to this existing shareholders, right? So this is acquisition of funds. And second one is utilization of funds. How best the firm can utilize the funds, right? The firm, how best the company can utilize the funds after receiving the funds. One hand, we receive the fund, how best, right? Company has to take appropriate decisions. Every decision has to get this company revenues are increased. Nothing but increased, right? If the sales are increased, at the same time, the firm can focusing on these costs also, right? So third one is C point, increasing the profitability. If these two are effective decisions are there, naturally the company profitability are increased. Right? The fund, whatever the funds are procured, whatever the utilization of funds effectively, the company are increasing their profitability for longer period. Okay, maximization of value of the firm. Ultimate object of financial management is maximizing the firm's value. We see the few companies like Amazon, Apple, right? Google. See that what we call Elon Musk companies like Starlink, right? These companies, the values are in terms of see the value. See in India also, see that we talked about Asian Paints, Reliance Industries, TCS. See all our top-notch companies see the value of the firm, maximizing the value of the firm. So how the maximum of our firm will increase? If the firm perform well, naturally the investors are ready to buy the company share, the values also grow. Right? Depending upon these sales. If the sales are there, naturally the maximum value is also focused. Okay, that is this functions of financial management in a brief. The third 1.4 we talked about business finance. Right? So business finance. So it's what the words it indicate. The finance is required for business purpose. So like fixed capital requirement is required. Every firm has to invest, right? Invest in fixed assets. A fixed capital requirement is there. Then working capital requirement to meet it day-to-day liquidity position to payment of salaries, wages, and purchase of raw material, payment of insurance expenses. So naturally, in a house like we need to pay all the expenses. Company has some obligation to pay the vendors, all these credit working capital requirements. Okay. So second part, meaning of financial. So far we discussed about this finance. Now we talked about financial management. Management is added in finance, right? There are two words are there: finance and management. So like uh, here, Western and design, he define financial management is an area of financing decision making, harmonizing individual motives and to enterprise goals. So individual to enterprise goal. So then Harvard and Upton, he defined the financial management is application of these planning, controlling functions to these financial functions, right? So like all threes are very clear, financial management is a specialized activity which is responsible for obtaining effective utilization of funds and smooth, efficient running of operations of business. And therefore, it includes financial planning, financial administration, and financial control. Like so, after this decision, financial uh, management definition, the importance of financial management. The financial management is very most important in especially in the financial departments, right? It may be called financial controller, director of finance. So he's only responsible for procurement and proper utilization of funds and in managing, coordinating between all other branches like HR department, procurement department, other soft department, every department linked with finance department, right? So like it, finance department is very most important, very most important department. Without finance department, there is no firm is there. There's no company running without finance department. Right? So why the financial department is required to success of promotion depending upon this financial administration and most important smooth running of the enterprise. Right? So nothing but the smooth running of this firm, right? Financial administration and coordination of various financial activities, functional activities, focal point of decision making, right? So what are the objective? Now it is very most, we entered, what is the object of financial management? What financial management will do, right? The financial management is only management to identify the company growth, how the company will grow. So financial management is planning, organizing, controlling of financial activities such as procurement and utilization of funds of the enterprise, right? So here the objectives are, there are two objectives, actually get two objectives, maybe it may be three or four, but the four very core objective is for maximization of profits. Every firm has to increase the company profits, maximizing the profits, right? How best the company manager has increased the company sales and controlling the cost. It is the only way to increase this sales and controlling the cost. So controlling, increasing the sales means in terms of revenues are increased, naturally the firm can get maximizes their profits, right? It may be short-term profit, or long-term profit. So it depends upon the nature of the firm. The firms are different, the business models are different, the activities are different, the scale of business is also different. Depending upon the competitive markets also different, competitors also different. See, we talked about Zomato, Swiggy. Two firms are there. They also see how they're maximizing their profits. Now, the objective of financial management second one is wealth maximization. Whose wealth? The shareholders' wealth has to be maximized. So this is the main objective of financial management, maximizing the shareholders' wealth. How it will possible? It possible through taking of appropriate three financial decisions. Three financial decisions are three financial decisions are one is investment decision, a financial decision. Third decision is dividend decision. If the firm has to take appropriate decisions about three, The firm's for the maximize the value is the firm value is increased if the firm take good investment decisions, good financial decisions, and dividend. These three are helps to this company to maximizing their earnings, maximizing the wealth of shareholders. Right. So there are three functions. If the financial management take two, three decisions, the firm can maximize its shareholders' wealth. Okay. Then the market value. So if the firm take appropriate good decisions, naturally it helps to company sales, bottom line growth as well as downline growth, bottom line growth as well as top line growth. So top line growth nothing but sales, and downline no, bottom line nothing but EPS, earning per share. If it is good, naturally value of share maximization increase. Most people buy the company share, right? So we'll see this talk about we'll take the DMart company share. We'll see the Bajaj Finance. See these two companies, emerging companies, the share value is multiple increased. Why this shareholder? Why the value is increased? Because of the business model, because of this company revenues, because of the company EPS, book to the EP ratio. Then the maximization of value is there. Third one is this is the very most important. Ultimate objective of financial management is maximization of wealth of shareholders. Okay. Third one is proper estimation of financial requirements. The firm has to estimate properly. Okay, if the firm has estimated properly financial requirements, then it's good. So if the firm is unable to estimate the financial requirement, that will affected company sales, company revenues, company profits. So everything is problem if the company unable to expect proper financial requirements. Fourth one is proper mobilization. The firm has to mobilize the funds properly. Right, the company has so many options are there. For example, Bajaj Finance required 100 crores. Right, Bajaj Finance required 100 crores for opening of new more stores in semi-urban area also. 100 crores are there. Company require 100 crores. The company has many options are there. Like they can go for bank loan. The firm can issue the equity share. The firm can go for issue the debentures. Like company options to mobilizing these 100 crores. But everyone has some its limitation. If the equity share is issued, if the equity shares are issued worth of 100 crores, the equity is diluted. If the firm issue the debentures, the company has to pay interest on its debentures. Bank loan, debentures are there. Each source has some cost is there. The 100 crores is not available at free of cost, right? The company has to pay interest to bank or issue this debenture. The company has to pay interest. And equity shares, the number of shares are increased. The stake is also increased. It's also affected in dilution of shares, equity shares, right? Proper mobilization is also required, right? So this is proper profit out of three. Which one is better? Anyone please respond? If Bajaj Finance require 100 crores, which of the best option? Either issue of equity shares, debentures, bank loans. Which one is better? Please, anyone please respond. Which option is better?
I think equity shares.
Equity shares is better?
Yes, I think.
Okay. So, any others? Any other? If the firm is able to pay, if it's a growing firm, if it's a growth firm, the firm can get bank loan or debentures, right? If it is a growth firm, right? See this, we talked about the three different types of firms: growth firm, normal firm, decline firm. If it's a growth firm, if the firm can borrow the funds at a lower rate, debt is we say that this is the debt. We talk this is the debt. These two are debts, debt and equity. Debt is always a cheaper source compared to equity. Equity shareholders are expecting higher return, and banks are paying it to maybe 8%, 9%. But the equity shareholders are expecting minimum 12 to 15, 18%. right? It's very difficult to satisfy the equity shareholders, but it's very easy to pay this bank interest or debentures interest. Why? Because amount availability is very cheaper. Condition is if it is a growth firm, then only if the growth firm is there, better to go for equity, better to go for debentures or bank loan. If it is not growth firm, but better to go for equity shares. Right? Both are some advantages, some limitations also there. These two options. After this mobilization of funds, proper utilization of funds, right? See that earlier I talked about this 100 Bajaj Finance mobilize 100 crores. So what they do? So if they have said that no, if you buy your company share, I will clear my debts. నేను అంతకుముందు అప్పు తీసుకున్నాను అప్పు కట్టేస్తాను బెటర్ టు బై మై కంపెనీ షేర్ లైక్ దట్ ద కంపెనీ ఫ్యూ కంపెనీస్ రీసెంట్లీ ఫ్యూ కంపెనీస్ దే కమ్ ఫర్ IPOs they say that we utilizing these whatever the IPOs amount even these uh, Adani group Adani also same so they also FPO is there Adani's follow on public offer say that 20,000 crores so Adani is also failed right Adani what that is if you buy my company share and whatever the 20,000 crores, I will utilize these 20,000 crores for clear my debts. Okay, so that is the case, proper utilization of funds. So as investors, we will see this. If I give 100 rupees to Bajaj Finance, what they do? Are they clearing their own debts? Or they are expanding their business operations? Are they entering new business models? So like what properly the firm can utilizing their resources, maintaining proper cash flows, right? The maintaining cash flows is also very most important. Now, why the cash flows are important? Payment of raw material, payment of wages, salaries, rent, and other expenses. Other expenses, these cash flows are very most important. Cash flows are very most important. Third one is survival of company. The company has to survive without finance. The firm survival of company, creating reserves. The firm has to create its reserves. Reserves can be used for future growth, expansion of business model, expansion of businesses, entering new markets. Okay, so then creating some results. The firm is also creating some results. Proper coordination is also required. Financial management try to uh, coordinate all these. Proper coordination. So create goodwill. See, we talked about few company names only. I took only two companies or three companies. That is Bajaj Finance and uh, DMarts, few companies. Why? It's a creating goodwill, right? It has a good business model. In future, also company getting a good revenues. Comparing this HDFC and other company shares, brand is reputed, right? See, even though single company Bajaj Finance have 7 crores customers are there, 7 crore customer in a single company, right? See, DMarts in the Indian middle class families are increased. See this model of DMart business model, right? See, Asian Paints, other company also increase efficiency. If the financial management is also try to increase company efficiency all over the company department, proper distribution of finance to all the departments, increase the efficiency. So wherever the required in each department, finance, HR department, other departments, sales department, the finance can be allocated properly. It helps to increase efficiency. Financial discipline is one more important in financial management. Reduce the cost of capital. As earlier we told you, reduce the cost of capital, right? So what is the cost of capital? The cost of capital, nothing but the firm can mobilize the funds, right? Procurements of funds. The funds can be procured at lower interest rates, borrow the funds at lower interest rates rather than high interest rates. So company, right? Company wants some amount. Bajaj Finance require 100 crores. What they can do is they can mobilize this 400 crores at lower interest rate, not the higher interest rates. Right? If this lower interest rates, whatever this advantage, that advantage goes to the equity shareholders. The financial manager must plan capital structure, how much debt is required, how much equity is required, right? What is the minimum cost of capital is required? Debt-free, right? Debt-free companies also required. Lower debt and lower interest rates always advantage. Reducing operating risk, right? Always the operational risk is there. Try to operating risk. There may be risk and uncertainties in a business. The financial manager must be step in reducing this risk. He must avoid higher risky projects. See, few companies, their operational risk is there. The company cannot be survive longer period. If the uh, new player entered the market, right? Naturally, see that recently, now flip what we call last week, this week only, this Facebook, they entered like a similar kind of Twitter accounts. They have to maintain. They started business in same kind of Twitter kind of social media networking business. Facebook, Meta company. New operational risk. What about some time that will affected in uh, Twitter also? So new player entered. Suppose example, EV vehicle, electric vehicle, Tesla car entered Indian markets. It's a little bit problem in existing companies. New player in the market, or the government take any policies, particularly pharma companies. If the company government take some decisions, so to reduce to not allow the drug for this usage of public, this is not good for now. See that US company, US government say that Indian farmers are not up to standards. That field operational risk is also there. High risky projects. Proper capital structure. See how much debt is required, how much equity is required. That has to be managed. The scope of financial management. The scope of financial management, we talked about estimating financial requirements. The firm has to estimate the financial requirement, deciding capital structure, right? How much uh, debt is required, how much in equity is there, right? So debt is always cheaper source. The firm can go for debt if the firm has growth firm, the firm has good future, and see that revenues are good, company's EPC is good. That firm can go for taking a loan instead of equity shares, right? Or the company is already debt in their balance sheets. There is no further scope. The company can go for issue of equity shares, right? The company can balance both debt and equity in their balance sheets, right? Selecting the source of finance. Earlier, I told you out of issue of shares or debentures or bonds or retained earnings, the company has selecting the appropriate source, the cheaper source, and the cheaper source of finance. See that the firm various sources available, reducing equity shares, debentures, financial institutions, commercial banks, and public deposit, etc., are available. Out of which the company is selecting for good source at cheaper source. And after the source, selecting a pattern of investment, where to invest, right? And how much amount going to invest. So what is the firm? How much amount is going to invest in fixed assets? How much amount going to allocate in working capital purpose? How much? It is if it is fixed asset, if you invest in a fixed amount, appropriate amount, it will increase. It will possible to company grow. Some companies working capital required huge, but they required limited of fixed assets. Some companies required huge amount of fixed asset and limited amount of working capital. Why? Because the business model is like that. So depending upon business model, how the company is selecting the pattern of investments. Okay. Next one is proper cash management. So cash is a very good, it's very difficult to manage the cash. So cash needs for different times and different make arrangement for the cash. The cash should be at either the shortage or it may be sometimes is ideal. The firm is a problem, right? Cash is a very peculiar asset. Right? Sometimes the balancing very difficult. So companies say that company selling their sales is good, 100% sales are increased, but the cash flows are not increased, facing a problem of liquidity problem. Right? And then implementation of financial control. So financial control is also required, like financial control methods are ROI, return on investment, budgetary control, break-even analysis, cost control, cost and internal audit, all are help to the company to controlling its own cost, right? So, like these are this scope of financial management. After that, we'll move to wealth maximization versus profit maximization. Everyone know that a layman also understand every firm object is profit maximization. But today onwards, you say that what is the object of every firm? Every firm, the object is maximization of wealth of equity shareholders, maximization of the wealth of the company. Right? Here, any doubts? What is the object of every firm? Every firm, the object is maximizing the value of the firm. So whatever the company take a decision, either financial decision, dividend decision, investor decision, or helps the firm to maximizing their value. If the firm value is maximized, nothing but maximizing these shareholders' wealth. Right? Why not this? What are some limitations? What are some limitations in profit maximizations? Profit maximization is very vague. No, profit management. The profit earnings of the prime aim, the economic activity. Business being an economic institution must earn profit to cover its cost over and provide a fund's growth. But here the limitation is ambiguity. So which profit are you going to maximize? Is short-term profits or long-term profits? Does it mean total profits or earning per share? The revenue profit is increased, but the total profits paid to these bank interest loan, bank interest or debenture interest. What about the equity shareholders? They are the real owner of the company, right? They are contributed more in their right. So what about this profit maximization is very vague and what we call ambiguity is there. There's no, it's operating profit, is non-operating profit, short-term profit, long-term profit, gross profit, net profit. Which profit we are going to maximize? That is the reason the profit maximization is ambiguity. So we with the priority for wealth maximization. The second thing is ignorance of time value of money. Right? Money has a time value. Right? So today rupee is more value than after 1 year. But the profit maximization are totally ignored time value of money. They say that the figure is there. But after no, we say that present values and future values. After 3 years, the value is different. Now the value is different. Right? After 3 years is a 3 lakhs. Now it's not a 3 lakhs. And present value and future values. The profit is major when the ambiguity. The second one is ignorance of time value. Third one is ignorance of risk factors. The firm is getting good revenues, good profits are there. It doesn't consider any consider the risk. Right? See that there are two projects are there. A project, a more risky project, and normal risky project. Risky project naturally could earn higher return, but profit doesn't say that these profit. For example, I will tell you. I will take an example. There we need to do business. Two kind of businesses. One is selling a cloth and selling in other businesses is a more risky business is there. Like any other business, very risky business. B business is a risky business, and A is not risky business. But these business getting the profit is 30% rate profits are there, and this business getting on 20% profits. So if you compare to A company and A business firm or B business firm, B business firm is return is very high, profits are very high, but the risk is also very high. Right? So high risk, high return, low risk, low return. But in financial management, what we can do is, as financial management is, it has to getting the higher return at lower level of risk. Right? So that is ignoring some risk, dividend policy. So it ignored the dividend policy, the effect of dividend policy and the market price of share also not considered the idea of profit maximization. Right? Because of these five limitations, so the profit maximization is not considered in financial management. It's important, but it's not that much. The very important one is wealth maximization. The wealth maximization is the main objective of financial management. Every firm, the ultimate and single objective is wealth maximization of this company shareholders. Value of the firm is increased, right? So wealth maximization is the appropriate goal of any enterprise. I think today onwards, we say that every firm, the object is maximizing the wealth, not the maximizing the profit, right? Any doubt here? Any doubts? Any doubts?
No, sir.
Not good.
No, sir.
Right? So today onwards, every firm, the object is maximizing the wealth, not maximizing the profits. Okay. So maximizing the wealth of shareholders. So how it is possible? If they take a proper decision, when this firm maximizes shareholder wealth, the individual stockholders can use this wealth maximizing maximum maximize his individual utilities. Right? If the value is increased, right? If the value is increased, naturally the share price increase and share the number of shares into current market price. The firm, see that I will give you an example here. Right. Right. So, for example, you take about Bajaj Finance, just understanding purpose, Bajaj Finance. Last year, company EPS is earning per share increased 30%. At that time, the company share value is 3,000. Right. The company existing shares are, for example, we assume that 100 shares, just understand purpose, 100 shares. The company value is, right, 300 into 3,000. 100 into 3,000. Right. 3 lakhs rupees. But this year, the company profits are increased. This year, the company profits are increased. Right. The company EPS increased by 50%. The share is also increased 5,000. 5,000 company share. Why the company share is increased? Because of the company profit. Company performing is well, and because there is a share value increased. So now 5,000 into 100, 5 lakhs rupees. The firm capital is, earlier it's 3 lakhs, now it's 5 lakhs rupees. How it is possible? This is possible because of this company EPS, earning per share. Okay, if the company earnings are increased, the natural share value increase. Okay, so number of outstanding shares into current market price will say that that is the value of the firm. So given the number of that, given the number of shares that stocks can own, so higher the stock price per share greater than value this equity shareholders. See these companies. You can see this few companies share values. See the Tesla company share price. Right. In India, also few companies share price, Bajaj Finance, other companies share values are increased because of the company profits, company revenues. Okay, so it is a prospective idea of a prospective idea. The objective is not descriptive of what the firm actually do. So the objective wealth maximization is not not necessarily socially desirable. So see that we can't consider it in a business. We can't consider this social concept, all these, right? There controversy. So the firm is required maximum profit. See these Adani Group, some companies, they are increase the value. I don't know it's illegal or legal, or it can be relations, it can be government policies. We don't know, but we will see on that. Only the firm is maximizing the value or not. What about the EPS? Right. So this is this objective of financial management. Second thing is the relationship between financial management, other discipline, other subjects. So financial management is closely related to production departments. Right? Why? Because the production department is a major department to produce the products, and the product is a what we call major source to the revenues. Right? So production department linked with financial management. Why? Because the production cycle required skilled labor, unskilled labor, shortage of finished goods, and capital utilization, production assumes all are required in production department and finance department, hand to hand, they going for safety, all these matters. After that, financial management is also help with material departments, procurement department. How much raw material is required this year, right? How much metal has to maintain if it is shortage level affected this company sales, how much required, right? So see that the financial management and metal manager in a firm come together, determine EOQ, economic order quantity, how much quantity we need to buy to as per our market demand, forecasting demand, safety level, how much stock is required, safety level required, and uh, uh, storing places requirement. So what is the storing place requirement? Stored personal requirements, all under see that why? Because in a manufacturing company, the material cost may be 750 to 60 per some time. You see, you talked about sugar company. So sugar cane, the major source material is there. Cement company, major. Steel company, steel is the major cost, right? So like the financial management and metal management put together, they work on hand to hand. Now the financial management and personal departments. So personal department nothing but the HR department. So where the employee welfare, employee benefits, all are employee welfare, revision of their pay scales, incentive schemes, all decided by this personal department and financial department, both financial department and also integrated with marketing department. So marketing department is concerned with selling of the goods and services to the customers, and it may be how the sales can be increased, how much amount paying for spending for advertising purpose, and are the company giving any discount rebates or any kind of one plus one offer, or can company give for any other advertisement, or company going for appointing brand ambassador, all these the market department and the finance department put together, they took a decision. Financial management and accounting departments. So accounting, the firms, finance, nothing but the treasurer is there. Accounting department is a controller. So two different people have two different targets. Finance management is a treasurer, and accountant is a controller of this whatever the cost is there. So like these financial management is integrated with various departments like what we discussed earlier: production department, material department, personal department, marketing department, and account department, right? All the departments are integrated with the financial management. After this, we move to our second topic. Second topic is financial planning. Okay. Up to here, any doubts? Up to any doubt? Anyone, please? Any doubts?
No, sir.
Any doubt? Okay. Shall I continue for first
Continue.
units or any doubts are there? Okay. First unit, any doubts? Okay. See that here the question is explain that in detail objective of financial management. So you have to write two objective: wealth maximization and profit variation. Okay. So here the question is discussion with relationship finance management to other discipline areas like production department, material department, personal department, marketing department, and account department, like the relation between all these, right? So here, see that financial function is concerned with allocation of funds to specific assets and obtaining these best maximum max of financing in relation to the overall. See that the object of financial management is also given here. Okay. So now we move to second unit, that is financial planning and forecasting. Financial planning and forecasting. So here the financial planning is main concern with economical procurement and profitability usage of funds. Here again two, right? Economical procurement and profitability of usage of funds, right? So the financial functions, the financial planning uh, covers cost of cost capital can be raised, capital cost can be raised of funds, type of loans to be raised. Okay, rise. Forecasting, forecast the extent to which the required funds will be made with internal and external sources, developing the plan to obtain to to obtain uh, right, analyzing financial results of operations, all this. Now, what is financial plan? The financial plan is a statement estimating the amount of capital and determining its composition. First thing is estimation of capital is how much capital is required to start a business or is already started business. How much capital is required for expanding its operations? How much capital is required to enter other markets? Right? Determine composition. After this capital, how much amount can I procure by own funds, or how much amount I can procure for the issue of shares? How much amount can procure for issue of debentures or taking a bank loan? It's a composition of these three. The amount of funds needed depends upon assets required of the business. The time at which the funds will be needed should be carefully decided. The finance as raised at the time when they are needed. How much based on that you have to procure the funds. See, if you procure earlier, the firm has to pay dividend. If the equity share, the firm has to pay dividend. Or debenture, the firm has to pay interest. Bank loan, the firm has to pay interest. Right. So financial planning. Financial planning includes operations, creates reasonable expectations, and measures and actual performance against set goals. Right? The both financial planning and forecasting are managed on a continual and regular basis since the constant accumulation of new ideas can affect the long-term strategies and goals. Based on this, concept of financial planning covers the whole business plans, financial concern, and operations. Right? Every firm has to, right? They go for continuous years together. You can see the Tata's 1907 to still 2023. The firm is running continuously. Some companies more than 100 years. Some companies 150 years history. Some companies has 50 years. So how they have a future goals. The financial planning means deciding in advance, right? What next? What are changes going on next to 5 years? What's the impact on AI and technology industry? What is the impact in AI and IT industry? Right? What about this coding and non-coding business, coding and non-coding? If Chat GPT writing this coding all these, what about the lower level jobs? If the robot, driverless cars are there, so new technologies are emerging. Right? AI impact in various segments, various sectors are there. Right? Deciding in advance. If AI is there, what about the new, right? See that the medical industry, medicine also, medical also, there is a huge impact in AI, artificial intelligence. Even the school education also, in case education also, AI is impacting, right? So think in advance. What are the changes are going on these AI? See that now the Google facing a biggest problem in the AI, ChatGPT AI. Where they started the bird, but still AI, right? Existing business and new business, they have to balance these two. Otherwise, Kodak company, no, and Kodak company and other telecom companies. See, the Kia, there is no Nokia company now is there. So think in advance. The company is also deciding in advance, and the planner of a business and financial policies must be that acquired finance is available with concern. So opportunities are come if the company has a good in cash flows in their balance sheet. So whenever the opportunity is there, they will enter, they will buy, take over the company or merging other company. They enter new markets. Like if the company have a good financial plan, good financial sources, good results, then they can capture these opportunities. They can grab the opportunity wherever these are possible. Right? If the company doesn't have the cash reserves, if the opportunity is there, the company are losing their opportunity, right? The financial planning is required. Financial planning has to determine strategies, goals, operating procedures of business, adopting new technology. If the company has a good financial resources, good financial result, the company can opt new technology. See the difference between what we call Airtel and VI, and we can compare Jio. You entered with a new technology. But whereas these Airtel and other companies, they are balancing both new technology as well as old technology. They're paying higher cost compared to these Geo telecom services. Geo telecom services, there is no problem of old technology, right? But these two companies, old companies, they has to maintain both old technology and new technology, right? So if the finance source is good, they can definitely move to this new technology. What are the strategies for financial planning? The financial planning must be strategic, either long term or short term or mid term, based on the period, right? Based on the period, long term and short term. The long term, maybe see that sometime it may be 2 years and 20 years. See the business, we don't know after 20 years what happened, right? Company has adopting new changes, adapting new changes, identify customer needs and preferences. We see the market, right? EV electric vehicles in automobile industry, right? Driverless cars or AI, no teachers required, impact in AI. So AI solve most of these lower level jobs, lower level problems. It will solve, right? Accuracy is there. Right? These also influencing in a business. Every business is influencing either directly or indirectly the AI impact is there. The company has to adopt, right? In 20 years, we don't know what are the changes going on in this world and technological aspects and all this. We don't know what are changes going on in uh, medical industry, going on education industry, and going on telecom industry. See this pharma industry. We don't know what are changes going on, impact AI, new technologies. But the company has to adopt the new technologies and whatever changes going on. The smaller step are often less concerned with the long-term planning, getting off around the surviving. The company has survived. See that Google, see the Google company, how it will survive and conflicts are entered, new technology entered, political challenges are there. Still the company is surviving. See that our companies, Tata companies, more than 100 years of history, Birlas, okay, Tata Birlas, other companies, ONGC, we say that Maharatna, Navaratna, Miniratnas, right? And what are steps is required for the financial planning? First step is nature of industry. The industry, depending upon the nature of industry. So industry nothing but similar kind of, see that banking industry, all bank performance, pharma industry, pharma companies, okay, IT industry, IT firms are there, sugar company, sugar industry is there, film industry, film, all the film production, all are there, right? So every industry, its own nature is there. Manufacturing industries, service industries are there, telecom, right? So every industry is its own nature. Different industries are required different kind of asset structure and element of, see that some of the products are seasonal products are there. Seasonal, no, after season is over, now there is no much sales, right? So like that, the financial planning is required based on this nature of industry. Cyclical firm, non-cyclical firm. Cyclical firm, nothing but the influence of interest rates. If the government increase inflation interest rates, RBI increase interest rates, banks are increasing interest rates, that will affect in the real estate sector. The real estate sector include that will affected in cement industry, steel industry, labor market, and Asian paints. All 208 commodities are influencing one in decision, that is increase of interest rates. So that decision are influencing this all 208 commodities directly or indirectly. The second is standing of the concern, right? Standing of the concern, nothing but the firm uh, credit rating in the market, past performance, attitude of management, all this. So we pay people, right? How this company is. Company is a good company, it's branded company, right? A company is very famous, very popular company. That firm, they can easily procure the funds, right? A smaller firm, the company is not, see the problem of uh, Adani groups. So they are facing a problem of procurements of funds. But such Indian PU companies are there, they can easily mobilize the funds. See that Infosys company, they can easily mobilize the funds. ICICI Bank easily mobilize the funds. Bajaj Finance easily mobilizing funds. So like that, the standing of concern, future plans. If the company has a good future plans, they're formulating a good financial plans as required. Future plan, at the same time, future financial plan is also required. If we have a good plan, but you don't have any financial plan, there is no use of the good plan. Future plan is them at the same time formulating this future financial plan. So the plans for expansion and diversification of near future will be required. All these, okay, and availability of sources, whatever the sources available of these funds, easily available. The firm can problem no problem. If the firm is unable to mobilize the sources, also they can see that general economic conditions. So general economic conditions, nothing but the what we call purchasing power of customers, employment, and liquidity problem, bank interest rates, government regulations, and like so many factors also influencing company business, financial planning. Government control, like the government is always on eye of every business model, every business. See that whatever the change, see that the government supposing uh, taking some step, regulations also there. Let's see, GST is there, or increasing the tax rates, or commodities, or income tax is there, right? The government always focusing on the control. See, especially in pharma sector, is more regulated compared to others, banking and pharma, other sectors also there. Okay, so uh, determining the financial objective, financial planning normally involve the following steps. Determining first object is required. So what is object? The object is object must be very clear and very appropriate measure is there. Appropriate. Then after this object, for example, Bajaj Finance has entered semi-urban areas. Now it's urban areas. Now they need to enter semi-urban areas also. That's their objective. Financial objectives. Formulating financial policies. How much amount is required? Policy regarding the estimation of capital required. How much amount is required for entering semi-urban areas in all over India? Policies regarding this company credit, right? How much debt equity ratio is required? Appropriate amount for a securities to be issued, how much amount to issue a share, right? How much source is better, like formulating policies and developing financial procedure also is most important. Okay, now I stop here. Tomorrow we'll continue. Now, any doubts? So, for any doubts?
No, sir.
Hello, can I stop here?
Yes, sir.
Okay, tomorrow we'll continue at 3:30. If you have any doubts, please share. Already is 4:20, 4:40. Okay, so 4:40, I will stop here. Okay, thank you.
Thank you.